Just want to do a few acknowledgements of some of the folks that are here today and some of the people that are supporting you as pension plan members. We have many of our people from the pensions office here today: Garrett Federico, Rachel Brooks, Ifatu Osegbo, Adeze Okorafor, and then we also have our communications specialist here, Kurt Hoffman, and we also are supported by the IC team, including Daryl Pishik from ICT. So thanks to them for the great work they do. We're also supported today by Media Productions, so thank you to Media Productions and to Tim Chorus and Terry Ellington, who are supporting us in delivering this to the folks that are joining us online. Today we're going to have two presentations, one from Sun Life and the other from Aon. Sun Life is going to present a little bit about the plan itself, and then Aon's going to give us a little bit of a perspective on what's happening in the markets and what happened in 2024. If folks online, for those of you that have joined us online, if you have questions that you want to ask, you can send questions to our email address. That's pensions with an S, pensions.inquiries@usas.ca, sorry? Thank you. So it'll be pension, no S, @usas.ca. You can send your email questions to that address. This video is also going to be put on our public-facing website, so for those of you that are watching this afterwards, thank you for coming and watching this video. So before we get started with the presentations, I'm just going to turn some time over to Kieran Killick, the chairman of the board, to make a few remarks.
Thank you, Doral. Welcome and good morning, everyone. My name is Kieran Killick. I'm Director of Human Resources and the Chair of the Academic Money Purchase Plan Pension Committee. Thank you to everyone who's attending both in person and online. This pension plan is for us as members, and so your interest and engagement in the plan is greatly appreciated. I'd first like to introduce our committee members. Representing faculty, Dr. Marie Racine from the Department of Finance and Management Science, the Edwards School of Business. Dr. George Tanous from the Department of Finance and Management Science, the Edwards School of Business. And Dr. Andy Pollock from the Department of Economics and the College of Arts and Science. And representing administration is Julie Ukrainitz, Manager of Treasury. Marnie Wright, who's the Associate Vice President, People and Chief Human Resources Officer, and myself, Kieran Killick. And representing ASPA as an observer is Ken Glover with our ICT Enterprise Solutions team. Our committee meets 4 times a year, and over the past year, we have focused on the performance of our target date funds, investment managers, our pension plan custodian Sun Life, and in plan governance. And as my year as the chair ends in June, I do want to offer my thanks to the committee members for their preparation and participation in our committee meetings. I'd like all plan members to know that the committee is very active in the ongoing management and development of our pension plan and our members' financial future. I would be remiss if I did not address the current economic climate, particularly as it relates to the implementation of tariffs and the impact on the stock markets. As a committee, we are reminded of our plan's investment and risk philosophy in being long-term focused and providing members the opportunity to invest based on their personal risk tolerance. This will continue to be the committee's guiding principle. And before turning it back over to Doral, I would like to thank Doral and Adeze for their continued support throughout the year in supporting our pension plan committee. Thank you very much.
Thanks, Kieran. And actually, we'll now turn the stage over to John Sadok with Sun Life to do his presentation. Thanks, John.
Perfect. Thank you very much. So, my name's John Sadok. I'm a senior education consultant at Sun Life, and obviously today we're talking about assessing retirement readiness. Personally, I think this is one of the more interesting presentations we do. Hopefully you will all agree over the next half hour or so, because I think it's something that we're not really familiar with. I mean, this is a big part of our life. All of a sudden you become retired and you haven't really thought about it. You don't really know some of the things you should be thinking about. So I don't think anything we discuss today is going to be rocket science, but I'm going to point out some things that maybe you just haven't considered and maybe it'll make you think about things a little bit differently. Now, I prefer the presentation be relatively casual, so if you have any questions, shout it out, put up your hand, I'll answer during then, or afterwards if you have any questions, we can discuss it then. So some of the things you want to think about is, nowadays, we talk a lot about wellness. And I don't know about you guys, I don't really feel we really had this conversation 10 or 15 years ago. And I think one of the reasons we do talk about wellness so much, I blame this. I blame our phones. I blame our phones and social media for actually a lot of things in life, but I think it really affects our wellness because I think a lot of times we never take a time to pause and then we start looking at our phones, and I think it really affects us. And I think retirement is something that really affects people, and I think there's a lot of things you have to think about besides the financial matters. And obviously today we're going to discuss mostly the financial matters, but I think you really got to think about the mental side of retirement. A lot of people just aren't prepared for retirement. And I've met a lot of people as part of my job who financially were totally fine with retirement, but they failed retirement and they actually went back to work. And it's interesting because I've actually only met men that have done this. I've never met a woman that failed retirement. Oh, there you go. All right. Are you that individual? No. Oh, okay, good. This was going to get embarrassing. Oh, yeah, I wouldn't want to retire if I owned a winery. I'm with her. And every guy, when they tell you that they went back to work, they always have the same joke that their wife realized how boring they were and they wanted them to go back to work. But quite often the men just haven't been prepared. Maybe they don't have the social structure that they're ready for, and they never really thought about what are they going to do. Because I think it's pretty shocking when you retire. I was really fortunate. About 10 years ago, I got this opportunity to leave a job, and they paid me out, and I realized I had about 1 year that I didn't really have to do anything. I was shocked at the amount of time you have when you don't have a job. And these are things you got to really think about. What are you going to do in retirement? We do know that most people, when it comes to retirement, one of the things they do is they travel, go to countries they haven't been to. If they got grandkids, they spend time with their grandkids, or maybe they do some volunteering. And I would encourage you, look at all the different hobbies or volunteering you want to do well in advance of retirement, so at least you have an idea what you're going to do the Monday after you stop working. The other thing you got to think about is physical. Obviously, if you have some physical challenges, maybe that's going to affect you financially also. There could be a lot of effects about it. And it's really interesting. In my home, I just started studying French, and I speak a lot about retirement. I do a lot of presentations on Zoom. So my home thinks I'm a 65-year-old French person. And a lot of my commercials come out in French. When I'm on social media, I get a lot of videos about older people. And one of the things that I've learned physically, I would have always assumed as you get older, you really should be walking and think about stretching and stuff like that. The other thing you should think about is weight training. Apparently, weight training is very important. You want to be strong as you get older, which is a shock to me, but that's what all these videos are talking about. So think about that. But obviously, financial is a very important thing when it comes to retirement. So I got a question for you. This is sort of a joke, but the question I have is, what day of the week do you spend the most amount of money? What day of the week do you think most people spend the most amount of money? Saturday. I would imagine it's Saturday. Well, when you retire, every day is a Saturday. So are you prepared for that? And I think retirement is so much more challenging today than it used to be. When I compare my grandmother to my mother, I notice a very different retirement. So my grandmother was from Eastern Europe. She never spent a lot of money. When she was around, I would argue 80% of her budget went to licorice, and I took 90% of that licorice from her, and she was totally happy with that. And when it came to investing, I didn't speak to her about investing when I was a kid, but I know she had a lot of money invested in bonds, because back then, you bought a lot of government of Canada savings bonds, and you were making 15% interest. And typically, when you retire, you're going to invest a lot more conservative than maybe you're investing today. But when you're conservative today, you're probably earning 2 or 3%. So that's a lot more challenging. Not only that, you're probably going to live longer than previous generations did. And when I compare my grandmother, who really spent money on nothing, and I compare her to my mom, and my mom, every year or so, she's like, Johnny, I can't go out 3 times a week anymore. And I'm like, Mom, nobody can. You're ridiculous. But she spends a lot of money in retirement. She lives close to downtown Toronto, and she spends a lot more money in retirement than my grandmother did. So retirement today is a lot more challenging than it was for previous generations. So we got to think about things and make sure that we're going to have a good retirement. Fortunately, at USask, you guys are set up with a really good pension plan. So the University of Saskatchewan goal is to create an environment that promotes and supports the health and well-being of all who work at our campuses. Money can be a cause of stress for many people, regardless of age. It doesn't matter if you're just starting out in your career or close to retirement. Financial stress can have a direct impact on your physical and mental well-being. Here you can see that 48% of Canadians say they lose sleep because of financial worries. 46% of Canadians aged 35 to 44 found it difficult to meet their financial needs in the previous 12 months. And 44% said it would be difficult to meet their financial obligations if their pay was late. A lot of people have financial concerns. Maybe it's going to be even more challenging over the next few years because of the current environment that we're in. You want to make sure that in retirement, you don't have those same concerns because you don't want to lose sleep at night due to your financial situation. So luckily, USask provides pension plans and financial planning resources for employees to help employees focus on their work activities and help reduce the stress around retirement planning and help you meet your retirement goals. So some of the benefits include tax advantages. So contributions to these plans are often tax deductible, reducing your taxable income. Additionally, the investment growth within the plan is tax deferred until you withdraw the funds. So that's one of the great advantages of having money in a defined contribution pension plan as you folks do. You get employer contributions, so USask matches your contributions, effectively boosting your retirement savings without additional cost to you. I don't know if you appreciate, but whenever you invest in a fund, you're always going to pay a fee. It's not very transparent. But if you're investing through TD or Bank of Montreal or somewhere like that, you're paying a fee every year on that fund. You're paying a much lower fee through USask than you would be if you went to one of those financial institutions. So that's a great benefit. There's financial security, so these plans provide a reliable source of income during retirement, helping to ensure financial stability and long-term savings. Contributions are invested over a long period, allowing your savings to grow and compound, which can result in a significant retirement fund. So when we look at your plan, eligible employees pay a percentage of their paychecks into their pension plan. That amount is matched by the university. Here you can see the different amounts depending on your position, whether you're academic, senior administration. You can see the different percentages you get, and you get a match of that amount from your employer. So that's great. You get a 100% risk-free return on your investments. And this is very generous. So I deal with companies all across the country, mostly in the West, but I do deal with companies in the East also. I would argue the average plan is more like a 4 and 2, where you put in 4% and you get a 50% match from your employer. So this is great that you get a 100% match from your employer here. So did you appreciate that contribution rates of 14% for administration staff leave an additional 4% RSP contribution room? So I imagine a lot of people are aware you can put in up to 18% of your income into an RSP up to a certain maximum limit. So you might have additional room, partly because maybe you worked elsewhere and you weren't maxing out, but every year you might have some additional room from this plan also. I would encourage everyone to go to canada.ca, which is the Canada Revenue Agency website, open up an account under My Account for Individuals. There you'll see your contribution room, but I would imagine also a lot of you are doing your taxes right about now. You're going to receive a notice of assessment from Canada Revenue Agency after you do your taxes, and it'll tell you how much room you have. If you make a mistake, that's okay. We do have a $2,000 lifetime buffer, but keep in mind that there is a limit to the amount of money you can put into this plan because this is a defined contribution pension plan, and it reduces your RSP contribution room in the following year. So keep that in mind. Members should also consider a tax-free savings account as another potential retirement savings vehicle. I'm a huge fan of the tax-free savings account. It's sort of the opposite of this plan. So with the TFSA, you've already paid taxes on it, just like the rest of your income. You move it into a tax-free savings account, it grows tax-free, and you take the money out tax-free. So it's a really great vehicle, especially for retirement, and I'll explain to you later why you really want to consider putting money into that. So one of the things we want to do is we want to introduce you to May. Now, I appreciate not all of your situations are going to be similar to May, but you are going to have to make some of the same decisions that she's considering. So when we look at May, she's single, she's earning $60,000 a year, she qualifies for Canada Pension Plan and Old Age Security, she has investment savings of $500,000, and she's healthy. So she has an income goal of $42,000 in retirement. Now, that's the interesting thing about retirement. We get to decide what our income is. So right now, you obviously know what your income is for this year. Maybe you got a good idea what your income is for next year. But when you retire, you get to determine how much money do you want to earn each year, with the idea that you got to make sure you can earn it for the rest of your life, which can be quite challenging. And one of the things that we do know is most people are going to live off somewhere between 60 to 80% of their pre-retirement income. So when it comes to May, she was earning $60,000, so we decide to go right in the middle. We're taking out 70% of that, so she needs $42,000. So she has some money that's guaranteed from Canada Pension Plan and Old Age Security, and that's $16,860. She's going to need an additional $25,000 in change from savings. Some of it is needs. $5,140 is stuff she needs, and some of it is wants, $20,000 of wants. And these are things she has to consider when it comes to making her decisions. So some things she has to think about. Defining her retirement income goal. So how much money do you want to take out? And again, most of us are going to live off somewhere between 60 to 80% of our pre-retirement income. Obviously, that depends what you want to do in retirement. So I know a lot of people that like hunting and fishing. They got all their toys already. Those people probably need a lot less because of what they're going to be doing in retirement. There are some people, I'm not necessarily friends with them, but there are some people that like going to spas and want to go on cruises and stuff like that. Maybe they're going to need 80 or 90% of their pre-retirement income. So it really depends what you're planning on doing in retirement. What about retirement risks? You got to think about that. What about other sources of retirement income, other considerations, and then next steps? So how do you see your retirement? This is something you really want to think about in advance. So an effective retirement spending plan requires a vision of the retirement lifestyle you want to live. So what are your needs, wants, and dreams that make up your retirement vision? What activities will you want to enjoy? And as I mentioned at the beginning of this presentation, most people in retirement are going to look at three main things. They're going to look at spending time with grandkids if they exist. They're going to think about traveling to countries maybe they didn't get a chance to travel to. Most of us maybe are going to stay in Canada, considering the current situation. That's a big thing nowadays. And then also, are you planning on volunteering? And it's nice to check out, and also different hobbies. And it's nice to check out all those different things in advance so you see what are you comfortable doing? What is it that you think you're going to really enjoy over the next 10, 20, or 30 years in retirement? So one of the things you got to think about are how are prices going to change? Because this has a big effect on you in retirement. And I don't know about you guys, but for most of us, we never really thought about inflation until about 5 years ago. Because inflation for most of our lives was somewhere around 1 to 2%, maybe 2.5% for most of our lives. But recently we had a period of time where inflation was a lot higher. Maybe we're going to experience that again due to tariffs, but these are things that you have to think about because inflation doesn't affect us so much while we're working because quite often our income is increasing with inflation. Now, some things are going to stay the same, and by staying the same, we mean they're going to keep in line with inflation. Things like groceries, property taxes, insurance, things like that. Some things will decrease. Maybe you don't have a mortgage anymore. You're not saving for retirement. No Canada Pension Plan or Quebec Pension Plan. No EI. No work-related expenses, and most likely taxes. Some things will increase. The things you're planning on doing in retirement. Things like hobbies, entertainment, travel, maybe healthcare. These are all things you got to think about. So some of the risks you got to think about. What about outliving your savings? Longevity is the danger of running out of money because of how long you live. And I think this is a bigger concern more and more because we are living longer. What about inflation? Costs have more than doubled in the past 40 years. A good thing to know when it comes to inflation is be aware of the rule of 72. And the rule of 72 tells you how long does it take for cost to double. So let's say inflation is 3%. The rule of 72 tells you take 72 into 3. That means it'll take 24 years for things to double. So if you're 60 years of age and you look at your situation and you're like, hey, I need $50,000 a year to live off of, and you're like, I'm totally okay with that. Well, when you're 84, you might need $100,000 at that time. Are you going to be fine with that $100,000 of expenses at that point? What about market downturns? Obviously, it's going to happen. The worst thing that could happen to you when it comes to market downturns is if it happens at the beginning of your retirement. Hopefully, it doesn't happen for 5 or 6 years into retirement, but that's a big challenge if it does happen in your first 2 years of retirement, and you got to mitigate that risk to a certain degree. And what about unexpected events? Things like unexpected expenses, changes in health, death of a spouse, and things like that. So where will your retirement income come from? So there's a few different sources that we have. We're very lucky in Canada. We do have some government sources. Not every country in the world has these plans, and a lot of countries that do have it, maybe they're not necessarily viable. I don't know if you've been reading, but in the US, they're concerned about Social Security running out, not running out, but having some challenges by the year 2035. Fortunately, we're not in that situation at present in Canada, so it's nice that we do have this, but that's not going to be enough for retirement. Maybe you got it, well, you definitely have a company retirement program, so that's a great benefit. Maybe you have a personal RSP. Hopefully you have a tax-free savings account also. Maybe you got a home, maybe you got rental property, maybe you got other savings. Now, when it comes to the government plan, we got access to a few different government plans, but the main ones are Canada Pension Plan or Quebec Pension Plan for anyone that's lived there, as well as old age security. Can anyone guess, what do you think the average 65-year-old makes per month from both CPP or Quebec Pension Plan as well as old age security? Any guesses per month? 800? You'll be happy. I like that number. Any other guesses? All right, let's look at the numbers. Okay, so, and maybe you were just talking about CPP, QPP, because I meant both. Okay, so there's 3 main programs. CPP, QPP, which I imagine we're all getting, old age security, which I imagine the majority of us are getting, and then guaranteed income supplement, which is for low-income seniors, people over the age of 65. If you're part of this program for an extended period of time, you probably won't be eligible for GIS, but I encourage you to look at what that threshold is as you approach 65, because maybe you'll be eligible for it. Keep in mind, some of your assets aren't going to affect GIS. If you have a lot of money in the TFSA, that's not going to affect your eligibility for GIS, so you might want to build up that TFSA. But if you're in this program for a long period of time, you probably won't be eligible. But let's look at the numbers. So CPP, QPP, we pay into it. It comes off our paycheck. Does anybody have any idea what percentage of your income do you think goes into CPP? Any guesses? Pardon? 2%? We wish. Yeah. So I think at one time it was 3%, and maybe at one time it was 2%. But until about 6 years ago, it was 4.95%. And we were paying 4.95% up to a certain level of income called the yearly maximum pensionable earnings. So maybe you've seen those letters YMPE somewhere. And the yearly maximum pensionable earnings is somewhere around $72,000 right now. So if I earn 80 grand a year, I pay into CPP for the first $72,500, I think. And then for the rest of the year, I don't pay into CPP. I feel like I got a bonus because I get a little bit more take-home pay. I didn't get a bonus or a raise. But then in January, I become familiar with CPP again. Now, that was about 6 or 7 years ago. They slowly increased it. Now it's at 5.95%. So you're putting in 5.95% and your employer is matching that 5.95%. If you're a 65-year-old today and you've been putting in the maximum this whole time, you'd be earning $1,433 a month. This is indexed to inflation, so it will be higher once you reach 65, plus it will also increase based on how long you pay in at that extra 1%. So you can go to Service Canada and find out how much money you should expect from CPP QPP. Now keep in mind, this is based on someone earning around 72 grand a year now. The average Canadian doesn't earn $72,000 a year, so the average Canadian's making about $800 a month. And then we also have old age security. Anybody know what percentage do we pay into OAS? 0. Yeah, trick question. We pay nothing into old age security. This comes out of general tax revenues, and we get it based on how long we live in Canada. So if we live in Canada for 40 years after the age of 18, we get $730 a month. You have to live here for at least 10 years. If you live here for 10 years, you get 25%, so on and so forth. If you're planning on leaving Canada in retirement, hope you lived here for 20 years and you'll continue to receive old age security. But if you live here less than that, I think you only receive OAS for about 6 months. So when we look at this, the average amount you can expect is somewhere around $1,500 a month. The max amount you can expect is around $2,100 a month. I think we can all appreciate, for most of us, this is not going to be enough money for retirement. And when we ask retirees, how much money are you spending and where are you getting that money from? They tell us that about 38% of the money they're spending in retirement is coming from these programs. So they're bringing the other 62% to the table. So make sure you're saving up money on your own. Most financial planners will tell you we should be saving about 10% of our income. Fortunately, with the plan you folks have, that makes it really easy to do. So keep that in mind. That it's great that we have that, but it's not going to be sufficient. Yes?
A quick question. This OAS, is this something that you would get on top of CPP?
Correct. As long as you've been here for at least 10 years after the age of 18.
If you meet the time requirements, you get this. And for the CPP version, how strong is there a time function versus a contribution aspect to the function, right? So in many European countries, for instance, you have to have paid in for at least 40 years to get anywhere close there. And if you're done shorter, regardless of your contributions, you've got a very steep drop.
That is a great question. So they look at the money that you're putting to CPP. I think it's from 18 to 65 years of age. Then they take away your 8 lowest years. They appreciate maybe you're in school or traveling or things like that. Then if you're on maternity leave, paternity leave, or disability, they take away those years also. Those don't count, but all the rest of your years count. So it's between 18 to 65 minus your 8 lowest earning years, if that makes any sense.
Well, and let's say you just make contributions for, let's say, 25 years.
Yeah, so you're going to get a lot less, right? Because from 8...
Linearly less or exponentially?
I think it'll be linearly. Yeah. Yeah. And again, you can go to Service Canada and have an idea, but obviously, if you haven't been living here for that long, it'll be very scalable because every year will count a lot more. Right? So, a lot of people are aware that you don't necessarily have to take CPP or OAS at 65 years of age. With CPP, you can take it as early as 60. You can delay till 70. 10 minutes? Perfect. With OAS, minimum age is 65, but you can delay it all the way to 70. If you decide to take it, CPP, before the age 65, you lose 0.6% per month or 7.2% per year. So if you decide to take it as early as 60 years of age, you lose 36% of whatever you were supposed to get if you start taking it at 65. If you delay it past 65, you get an extra 0.7% per month or 8.4% per year. So if you delay it all the way to 70, you get an extra 42%. OAS is slightly different. You can't take it before 65, but if you take it after 65, you get an extra 0.6% per month or 7.2% per year. And if you delay it all the way to 70, you get an extra 36%. So a lot of people ask me, they're like, so when does it break even? If someone takes it at age 60 and they're getting all that amount at a discount, and someone takes it at age 65 at a different amount compared to someone at 70 taking it at the premium amount, when do they all match up? I don't like answering that question, and you could Google that if you really want to. And the reason why I don't like asking that question is it assumes you know your mortality. If you got biblical genes in your family, and a lot of people live to like 120 years of age, obviously start taking it at 70. If you're like my ancestors, you probably start taking it at 60 years of age. So it really depends on that situation. So no one can answer that. I read in the Globe and Mail, I don't know who wrote this, but he had a very interesting idea. He suggested that if age 60 you're thinking about taking it, ask yourself this question: do I need the money? And if you need the money, don't take it. And if you don't need the money, take it. I've already drank my coffee. I know that's counterintuitive, but this person's theory was interesting. This person suggested if you don't need the money, you can take it, you can invest it in the markets because you don't need the money, and the percentage you should get long-term in the market should compensate you for the discount. On the other hand, if you do need the money, it really depends what you mean by do you need the money. In Canada, a lot of us don't know where the word need means, and sometimes in the same sentence as need, we have Mexico in that, or motorcycle. We don't really need the money. But if you need the money for lunch, you're not asking a financial planner what they think. But I would argue, if you think you need the money at age 60, delay it as long as possible. Because trust me, you needed to start at a much higher base, because if you think you need the money at 60, you definitely need it at a higher base at 70, 80, or 90 years of age. The other thing to think about is if you're working, why would you take it? You're probably paying relatively high taxes at that point. Do you want to add on more income and pay taxes on it? That makes no sense. And not only that, the other thing you got to think about is with old age security, you're not going to get all your old age security if your income is above a certain level. There's a clawback starting around $90,000 a year. So if you're making a lot of money, why are you going to collect old age security if you're not going to get all of it? So that's something to think about. When it comes to old age security, I encourage you, please build up the TFSA, because we have some financial issues in Canada, obviously. One thing I know the government's going to consider at one point, they've thought about it before, is what if they change where that clawback threshold starts? What if they change and say, let's start it at around $60,000, but you need 65 grand a year to live off of? I'm going to take my 60 grand from the plan I have here, and that extra $5,000 I'm going to take from my TFSA. The government's only going to think I took 60 grand out, and I'm going to collect all my old age security. So keep that in mind. Try to build up that TFSA because it will make things much easier. Now, when it comes to your plan and you want to start taking the money out, you've got two options. One of the options you might want to do is put it into a PRIF. So with a PRIF, you'll still be investing, but this is where you'll be taking the money out. And when you put it into that PRIF, keep in mind, you'll continue taking money out for the rest of your life. So you're going to be making sure you're taking the money out and paying income taxes on it. So don't put it into the PRIF if you don't need the money. So when you're eligible and ready to convert your registered pension savings into retirement, you put it into this, but no later than the end of the year you turn 71. Your eligibility is June 30th following age 55, but again, no later than end of the year age 71. You're going to take a minimum withdrawal amount as set by the Federal Income Tax Act. That's going to change as you get older. It's going to be a minimum percentage. But the max amount you can withdraw from a PRIF is limited to the amount of money in your account. So you could take all the money out. I would discourage that because you're going to pay taxes on it. Why do you want to pay taxes on it if you don't need the money? Try to take the money out over the next 10, 20, or 30 years, but you do have that flexibility. So keep that in mind. Now, your spouse must sign a waiver form for you to transfer your pension funds to a PRIF, so keep that in mind. You must name your spouse as the beneficiary of your PRIF, and why wouldn't you? It would be a tax-free rollover if it goes to your spouse. If you don't have a spouse, you can name a beneficiary of your choice, and if you do not designate a beneficiary, your assets will default to your estate. Typically, I would suggest try not to do that. In most cases, that's not a great idea. Name a beneficiary. In terms of death benefits, your spouse may elect cash or a tax shelter transfer to an RSP RIF or a life annuity. If they take it out as cash, they're going to pay taxes on all that money right away. Maybe not the best idea. And if you do not have a spouse, a lump sum will be paid to the named beneficiary. You must withdraw a minimum percentage amount annually based on your age, and in most cases, your spouse's age. No maximum withdrawal limit. Withdrawals are taxable as income. Assets remaining in the PRIF and their investment growth are tax sheltered until withdrawn. Now, the other choice you have is an annuity. So keep in mind with a PRIF, you're investing in it, and when you pass away, it's going to go to your beneficiary. With the annuity, you're going to give a certain amount of money to an insurance company, and then we're going to guarantee you a certain amount of money every month for the rest of your life. And the amount of money we give you is going to be based on your age. If you start at age 60, we'll tell you a certain amount of money. If you start at age 65, we'll give you more money because we're obviously paying you for less years. If you're a female, we're going to give you a certain amount of money. But apparently, insurance companies like men more because if you're a male, we're going to give you more money. Why do we give men more money than women? Well, I think there's another answer. That is a good answer. Nothing to do with annuities, though. Different topic. Pardon? Yes. And the reason why I ask this question, I always like to ask this question when men or women are around, because typically a woman will answer it with a big smile on her face. She'll be like, because men die earlier. And that's true. That's why we'll do that. And also, the amount of money we give you will be based on prevailing interest rates. If interest rates are low, we're not going to give you as much as if interest rates are higher. And there's other variables. So keep in mind, annuity is a series of payment in exchange for a lump sum, no investments to be managed, guaranteed payment, typically monthly, no ability to change the contract once it is purchased. And in most cases, when you pass away, no money for your beneficiaries. So keep that in mind. With the PRIF, that money will go to your beneficiaries. I know I've only got a couple minutes. So when it comes to your options, when it comes to a life annuity, it's predictable and term certain. You know you're going to get a certain amount of money every month for the rest of your life. You can customize it. So there's but some of the things to think about is there longevity risk with an annuity? No, there's not. We're going to pay it to you for the rest of your life. If you live to 120, we're going to pay it to you the whole time. Market risk, no, you're guaranteed that amount of money. Inflation risk, you can customize it and make it move up with inflation. You'll start at a lower amount, but at least you know it'll be indexed to inflation. And a death benefit varies. You could make it where it's joint with your spouse, where maybe you enter into the annuity, when you pass away, your spouse will get 60% of whatever you were getting. Maybe you make it term certain and say, we want it for sure for 10 years. No matter what happens, you pass away 2 years later, we'll give you an amount, a commuted amount at that point. With your RIF, or your PRIF, it's flexibility in payments. You're not guaranteed for life. You could outlive your savings. There's market risk, but you have potential to generate higher returns. There's inflation risk, but also potential to beat it. And at death benefit, you get the market value, which could potentially be higher than the annuity. So keep in mind with the annuity, you're typically not giving money to the beneficiaries. With a PRIF, you are. Maybe you want to do both, right? So that's something to think about. And also think about it. With that annuity, if we're telling you we're giving you $500 a month, and you're like, that's awesome. Well, maybe that's awesome at 65. Is that $500 a month also awesome at 75, 85, and 95 years of age? That's something to think about. So remember May. So she has needs of $5,140 and wants of $20,000. She's got 3 options to convert her $500,000 in savings. She could purchase a life annuity. That'll give her $27,500 in guaranteed income. That'll cover her income needs and wants at the moment. Maybe it won't cover her 5 or 10 years from now, but it'll cover her for now. She can put it into a PRIF. She'll get income. Her income needs are covered. She's got possibility of extra money for unexpected expenses. Market fluctuations may cause impact over time. What about a combination of both? So what about purchasing a life annuity? So she has $27,500 in guaranteed income. So she gets level lifetime income, but no eligibility makes some changes. So what she can do is she could do a combination of both. So for her income needs of $5,140 a year, she purchases an annuity with $120,000. She covers her needs. Then she has $380,000, and that is what she'll do with her wants. So maybe that's one of the ways you want to look at your situation in retirement. Make sure your needs are covered. What else is important to consider? Do you have real estate? Do you have other savings? Do you have part-time work? In terms of next steps, there's a retirement planner at Sun Life. Please check it out. It'll tell you where you are in terms of your retirement planning journey, when you should be able to retire, and if there's any challenges. Do you have a significant gap between where you are today and where you need to be upon retirement? There's the annuity premium calculator. There's the asset allocation tool that can help you decide which investments are appropriate for you. You can plan your best retirement and look at the retirement planning guide and also financial advisor. If you go under tools, you'll find this retirement planner. It's called One Plan. There's a household plan available. You can include your spouse. We'll aggregate all your assets, provide you with an array of strategies, and we'll provide you with asset and income illustrations. I think everyone should do the retirement planner so you have an idea as to where you are today and what you need to do to ensure you have a good retirement. You have access to 360 plan advice. Press on that QR code if you want to reach them. You can book an appointment directly, call our Client Solution Center. You'll get personalized one-on-one advice, goals-based conversations. We'll help you stay on track to unlock your potential, and we'll assist you with life in retirement. You can download the mobile app from Google Play and the Apple App Store. Really simple to use, and you can press on click to call to reach us quickly. Go to mysunlife.ca. I find that a little bit easier if you're going to switch investments. Nice to have the big screen. You can also press on chat live now to get live support. Go on that QR code if you want to connect with an expert. And we have a webinar series throughout the year in English and French at sunlife.ca/mymoney. So monitor your CPP benefit estimate on canada.ca. Envision what you want your retirement to look like. Create a budget so you'll know how much it will cost, and create a plan by using the tools on mysunlife.ca, and obviously work with a financial planner for personalized advice and support. So I know that was relatively quick, and I think I went over time. Maybe we'll deal with questions afterwards. Okay.
I'm Alice Nichols with Sun Life, Client Relationship Executive on the group retirement side. So I work with the Pension Committee as well as the Pension Office in regards to the program for the Money Purchase Plan. So I'm going to be quick because I know we've got lots of great information coming from Garrett as well for Aon. Just wanted to share with you some of the numbers for the plan, some of the highlights. I know that there's a handout, I think. Yeah, there's a handout as well of this slide for you, so you can have the data. Just a couple of quick highlights. We can see that the balance in the plan is just over $1 billion. And then participation is 3.6 thousand, or that's an odd number, but good participation in the plan, 100% participation. It is a mandatory plan. Although we sometimes see that there's not full participation for people that are just joining or people that are retiring, that are no longer contributing to the program. I wanted to highlight the average assets per member and building off of what John was just saying. So your average assets per member are about $287,000, and that's per member in their account. That's actually higher than the industry average of $218,000. So that's great. People are saving for retirement. You have a very healthy plan, as John mentioned. Good employer contributions with that match. So legally, where you're going to get that 100% match out there, if you know where to get it outside of the plan, let me know. But so it's a great program to be participating in, and this shows that. You can see the investment mix there on the far side as to where the investments are sitting within the program. Along the middle is the investment performance rates for the program for the different time periods. One of the other items that I wanted to highlight just quickly along the bottom is the tool usage. So John talked a lot about at the end about tool usage and where you can get those tools, where you can get the support to help you for retirement. So we can see that although call center and website usage went down slightly, the mobile app usage went up significantly to about 54.9%. We are putting a lot of time and technology into the mobile app so that you can do these tools directly within your hand, whether it's on an iPad or on your phone. And so really helping, giving you that support to prepare for your retirement goals and ensure that you're meeting them. Okay, so that was quick. I'll hand it off to Garrett.
All right, hi everyone. My name's Garrett Gates. I'm a senior investment consultant with Aon. I work very closely with the Pensions Office as well as the Pension Committee in supporting all things for the Academic Money Purchase Plan. I'm going to start off today's conversation, do a very quick overview of the plan and what sort of the guiding objectives are, jump into capital markets performance. I'm going to focus most of my commentary on what went on in 2024 and looking at the results of your plan. Have some brief comments about what's been going on year to date, obviously very topical with the new president in the US. And then we'll spend a bit of time talking about the investment options that are made available in your plan. Okay. From a plan overview perspective, I think Kieran said it well. The committee, when thinking about designing the plan, takes a guiding risk philosophy of recognizing that individual members may have different risk preferences and different risk objectives. And so when we look at designing the options and investments that are within the plan, we really think about doing it in two different ways. One is providing a series of target date funds that are very well diversified across equities, across fixed income, and automatically de-risk over time for those members who really want a bit more of a hands-off investment experience, while at the same time recognizing that target date funds may not meet the needs of all members in the plan. The committee does provide a range of investment options across different equity regions as well as across fixed income and money market securities to allow members to really tailor their investment portfolio to their specific risk requirements. So taking that holistic approach and recognizing that members may have different objectives than each other. Okay. Kieran touched on the role of the pension committee, so I will skip right into capital markets. I'm going to start off with a brief overview of what went on in 2024. If we start up in the top left-hand chart here, we're looking at inflation rate in Canada. And to John's point, if you look back over the past 10 years, inflation tended to be around that 1% to 2% mark. Then came along COVID, and coming out of COVID, we've seen surge in prices, which I'm sure we're all very familiar with. We saw inflation in Canada reach about 8% in 2022. At the same point, we had a recovery in growth in Canada. So if you look at GDP growth, that dipped during COVID, then strong recovery coming out of COVID in 2022. At that time, central banks around the world, including the Bank of Canada, looked to slow the growth of the economy, but more importantly, bring down inflation to more reasonable levels with a target of reaching about 2%. We can see in the top right-hand chart, central banks raised interest rates over the past number of years, peaking at about 5% in Canada, and that worked to slow the economy, to slow growth, but most importantly, to bring inflation under control. We look at 2024, we can see inflation has come down, actually sitting around that 2% mark, so right around the target that the Bank of Canada had set. We've seen GDP growth come down. It still remained positive, but growth has slowed around the 2% mark. That said, at the same point, we have seen the unemployment rate in Canada over the past year or two start to tick up towards that 6.7, 6.6%. Unemployment has stabilized a little bit into 2025, but nonetheless starting to see inflation come under control, growth slowing but remaining positive, and a little bit of weakness showing up in labor markets. Central banks in 2024 and led by the Bank of Canada did start to cut interest rates, as I'm sure we're all familiar, and just earlier this week made another cut, bringing us down from 5% in 2024 down to about 2.5% today. So we have seen central banks start to reduce interest rates. Maybe just a couple comments on what's been going on in 2025. Obviously, with the new president in the U.S., with tariffs, we've seen a lot of uncertainty in markets. We've seen a lot of uncertainty from an economic policy perspective. One of the reasons the central bank quoted around continuing to cut interest rates just even earlier this week is really reflecting the uncertainty that tariffs and economic policy from the U.S. creates. If we think about the impact of tariffs, it's really tough to tell, at what size and how long they may be in place. Tariffs in general do work to reduce growth if we think about the impact on the Canadian market, while at the same point increasing inflation. So it does create a bit of a difficult environment for both Canadians, but also for central banks to handle. And so central bank trying to get a bit ahead of that and keep the economy going by bringing interest rates down earlier this week. Okay. On this slide, talk a little bit about performance and what went on in capital markets last year. So a lot of bars on this chart. What I would highlight, the chart on the top is looking at short-term returns. So if we focus on the blue bars there, looking at returns for 2024, the bottom chart is that longer-term perspective showing 5 and 10-year returns. If we look at the middle of the chart, we can see the performance of equity markets. Equity markets for the past year, as well as the past 5 and 10 years, have really been led by U.S. equities. Last year, they're up 36.4% in Canadian dollar terms, while Canadian equity is still a strong and healthy return around that 22% mark. International equities fared a little bit less, up about 13%, nonetheless seeing strength across the equity markets in 2024. At the same point on the left, we're showing returns for fixed income markets. So a couple takeaways here is cash or money market securities did quite well. They returned about 4.9%, while traditional fixed income investments around that 4.2% mark. I think what's most important, though, on this page is if you look at the bottom half of the charts and we look at long-term returns, equity markets have provided phenomenal returns for the past 5 and 10 years across most regions, averaging, if we look at global equities, around 11.6% over the past 10 years. So really contributing to the growth of your account balances and helping you save and grow your assets for retirement. And noting that long-term equities have outperformed bonds, and over the long term, that's what one would expect. If we look at long-term bond returns, they've been about 2% for the past 10 years. We think just a little bit further about what's been going on in equity markets. If some of you may have heard, equity markets have been exceptionally concentrated over the past year. If we think about what's driven markets, in particular in the US, it's really been, large cap tech stocks like the Magnificent Seven, so names like Apple, Amazon, Nvidia, Netflix, and Tesla. They've really driven the performance of equity markets. The chart we're showing here on the left takes a look at the sectors that those companies are in. Those are all the colorful bars. And then the bottom blue represents everything else in the S&P 500. And what you can see is that over the past year, up until about mid-November, we can see that over half the performance was coming from the 7 sectors or areas where those large cap tech stocks have been. And what this means as an investor is we're seeing more concentration. The chart on the right just illustrates the growth in some of these areas of the market that we've seen. So if we look at things like software or semiconductors, the weight in the index has increased quite a bit over the past 5 years. So seeing a little bit more concentration, some of these names really driving performance of investments. We have seen a little bit of this reverse in 2025. I'm sure many of you have seen the headlines. Tesla's down about 35% year to date. So we are seeing some reversal in this trend, but nonetheless, it has been driving markets, in particular in 2024, but also over the past number of years as well. This next slide, again, a lot of information here, but maybe just highlighting what worked and what performed well in markets. If we look at the bottom chart, we're looking at U.S. equity markets, and here you can see things like IT, communication services, again, sectors that hold names like Amazon and Apple and Meta performed exceptionally well, up about 50% last year. Other areas of the market like consumer discretionary and financials also fared well, up around that 40% mark. And on the right, we really summarize performance, I think, quite well of the trends in the market. If you look at what it performed exceptionally well last year, it is large cap growth stocks, so up about 47%, while value stocks were up about 25%, but lagging behind the market. Okay. With that, we'll get into the performance and overview of your investment lineup. So on the first slide here, we're going to talk a little bit about the options that are made available. So as I mentioned, the plan and the pension committee has made sure there's a wide range of investment options available for plan members to be able to customize their investment portfolio to meet their needs. In the center of the chart here, we're showing target date funds. So that's that what's sometimes referred to as a do-it-for-me approach. It's a well-diversified portfolio of equities and bonds that automatically de-risks over time. We'll get into that in a bit more detail on the coming slides. But at the same point, also offering individual investment options for those members who want to customize their portfolio further. In the bottom left-hand chart, we show the lower risk investment options in the portfolio, so your traditional fixed income bond fund, as well as the money market options that are available. And then as you move up the risk spectrum, providing options in Canadian equities, US equities, and international equities. Okay. So what are target date funds? Target date funds are really that simplified investment option. As a plan member, all you have to do is pick the year that you want to retire and select that vintage as your investment choice. So if you were born in 1967, you want to retire at age 65, you'd go in and select the 2030 target date fund. What this target date fund is going to do is automatically adjust your allocation to equities over time as you approach that retirement date of 2030. So the chart on the page here shows the percentage of equities over time. If you look at young members who have a very long time horizon, they're holding a lot more equities, close to 100% weight in the portfolio. Over time, as one approaches age 65, the plan will de-risk around that 60% equity mark. And then as members enter into retirement, continuing to de-risk the portfolio up until around age 75, where it remains static. So Target date funds, really that simplistic option. You can put your money in it, you can forget about it, you can let it automatically de-risk over time as you approach retirement. If we think about your plan, about 83% of plan assets, or the vast majority of plan members, are utilizing the target date funds, and this has been a fantastic benefit. If we look at the returns since inception, so these funds were introduced to the plan in February of 2023, we can see the since inception returns here on the right. The longer dated vintages would have more equity exposure, returning an annualized 17.5% across most vintages, and those approaching retirement earning a little bit less because they have less exposure to equities, but nonetheless a very healthy 11.4% for those who retired in 2020, 14.6% for those looking to retire in 2030. So provides really well diversified solution that's simple for plan members to use. Okay. Now, for those of you that are interested in customizing your investment portfolio, maybe altering the risk profile, if you'd like something different than what's provided in the target date fund, the next few slides that I'm going to go through will cover the options that are made available to you. The first option I want to talk about is the Canadian Equity Fund. This is a actively managed fund that uses 3 underlying investment managers that provide a well-diversified and range of equity exposures. The fund is sub-advised by Beutel Goodman, Galibier, and Foyston Gordon and Payne. Beutel Goodman is what we'd refer to as a value manager, while Galibier is a little bit more of a growth manager, and FGP is a value manager investing in smaller cap or smaller companies. The combination of these 3 managers provides a robust and well-diversified portfolio where they're seeking to outperform the benchmark over time. When we look at the performance of the Canadian Equity Fund, it has provided strong returns for plan members, a 10-year annualized return of about 8.5%, and last year was up about 15.7%. So providing strong returns and helping plan members grow their investment focused in the Canadian market. For those investors who want to invest outside of Canada, we provide a U.S. equity fund. This fund is passively managed by BlackRock. It's seeking to track the returns of the S&P 500, and it's done so, and it's met that objective since being added to the plan. We look at performance of U.S. equities. Here we can see a lot stronger results. When we look at equity markets around the world, U.S. equities have driven performance for the past number of years. You see an annualized 10-year return of about 15.5%. In the U.S. equity market last year, up about 36.5%. Okay. The other and last equity option made available to plan members is an international equity fund. Similar to the Canadian Equity Fund, it is actively managed and invested by Moore. Moore is a boutique investment manager based out of Calgary. They manage their strategy with what they call a quality at the right price approach. So they're looking for wealth-creating companies, but being cognizant of how much they pay for those companies, again, looking to provide that, looking to outperform the benchmark over time, while without taking on additional amounts of risk. When we look at performance of international equities, again, similar to Canadian equities, about that 8.5 or 8.7% 10-year annualized return. Last year returned about 16%. Healthy return on absolute basis, but did lag U.S. equities. Now, for those plan members maybe approaching retirement or a little bit closer to retirement who are looking for a little bit of a less risky option, there is a fixed income fund available. Similar to U.S. equities, it is passively managed, so BlackRock is seeking to track the broad Canadian fixed income market. We can see returns here historically have been in that, call it 2 to 4% range up until 2021 and 2022, whereas interest rates rose. We did see some negative returns within the portfolio for fixed income. But when interest rates rise, we see a negative return in that year, but the go-forward expected return increases. And we see that in 2023. The return was 6.7%, reflecting the higher interest rate environment we've been in. Last year, about 4.2%, as interest rates remained sort of above the historical trend over the past 10 years. Now, the last option we'll talk a bit about today is what we call a capital preservation fund, so looking at the money market solution. These are funds that are investing essentially in cash, very low risk. They're really meant to provide capital preservation and not expecting a lot of growth out of these funds. They're typically not meant to be a long-term investment for members who are younger in the plan. We tend to see members who are younger investing primarily in equities, Where we see capital preservation funds become used more is for those members approaching retirement who may want to take a bit more of a conservative approach. When we look at historical returns, they really mirror the interest rate environment that we're in. So if we look back from 2014 to 2020, earning about 1 to maybe 2% in any given year. As interest rates have went up over the past couple of years, we did see returns in 2023 and 2024 be around that 4.8% mark. That reflected, if we go back to the economic update, the higher interest rate environment we were in with Bank of Canada increasing interest rates. If we think about the environment we're in today, the central bank has brought interest rates down to 2.5%. So if we were to think about expected returns on a money market fund, most likely to be more around that 2.5% mark than the 4.8% we're seeing last year, reflecting that interest rates have come down. Okay. The last slide I'll touch on here today is just looking at assets in the plan. So similar to what Sun Life shown, we do see the vast majority of members investing in the target date fund. About 83% of plan assets, or about $850 million within the academic money purchased using that target date fund, which is also the default option. We do see some use of active management across, or of the standalone investment funds, with the U.S. equity fund being most popular, about 7.5% of assets in the plan. With that, I will pause there. I think I made up a little bit of time, but happy to take any questions from the group. Good.
Thanks, Garrett. And really appreciate the presentations today from both Garrett and John and Alice. And if you do have questions, please come to the mic. One of the things we want to do is make sure that the online participants, if there are questions from the floor, that they can hear those questions along with the answers. Maybe while we're waiting for people to think about some questions that they want to ask you, maybe you can talk a little bit, Garrett, just about the impact of those lower fees on the members' rates of return.
Yeah, absolutely. So I think John touched on briefly, one of the main benefits of keeping your money, both within the pension plan, but also in the group retirement vehicles that are made available, is the fees that are paid by plan members within this plan are substantially lower than what you could get in the retail market. If we think about fees in the retail market for a target date fund or an actively managed equity fund, you range anywhere from 1 to 3%. And so when we look at the fees paid in this plan, substantially lower, under 1%, and a very attractive. And when we think about, John made the comment of the rule of 72 and how long it takes your money to double over time. If you think about saving 1 or 2% in fees, that same math applies. So I won't try to do it on the spot like John did, but I'm just knowing that over a long period of time, the substantially lower fees that are made available through the scale that this plan has with over $1 billion in assets really helps compound plan members' wealth in the plan.
Okay, so a frustration, maybe I'll say frustration that I personally have with the plan is sometimes it feels like there's really no place to hide when markets are performing well, but the outlook maybe will continue on as we've seen recently. Markets have sold off. Bonds have done a little bit to compensate, but even bonds have lost a lot of their diversifying characteristics. So has the committee considered adding new asset classes like REITs or ETFs, anything that might be offer some sectoral diversification? Just wondering if they've addressed some of those concerns or if they're considering adding some. Thank you.
Yeah, absolutely. And maybe to that, I will flip back to this slide here. So I think there's two ways that the committee looks to address these concerns. So one, knowing that the vast majority of assets are within the target date fund, which is already well diversified. The committee has spent a lot of time over the past year and continues to work to look at improvements that can be made within the target date funds, and are there ways to enhance diversification for plan members. You already have a very well diversified solution there, but can there be improvements at the margin? And something that's been key topics for the committee over the past number of quarters and continues to be on the plan to talk about in 2025. The second option is within those standalone investment options. I'd say what we tend to see across all pension plans in group RSPs and DC plans in Canada is a somewhat limited investment structure to broad-based Canadian, US, international, and global equity funds, as well as fixed income funds. And part of the reason for that is we know that market timing can be very challenging. If we step back and we look at very long-term returns, we've went through some very rough periods of time. If we think about 2020, equity markets were down at 1.30%. But if we look at the 5 and 10-year returns here, in history, when markets have sold off, we have seen recoveries. And really one of the best things that plan members can do is stay the course and continue to invest on a monthly, semi-monthly basis. You're buying in at the lows and expecting to recover over time. So as for specific investment options, we don't typically tend to see that level of customization made available to plan members, more looking for broadly diversified funds that over the long run will provide members with return potential.
I just have a question about do the people that run these funds, are they actively managing them right now? Like, for example, with the U.S. equity fund, would they be maybe selling some Tesla stock right now and buying other stock type thing? Like, is it daily managed or weekly managed, or is it like stay the course until the committee decides to make changes?
Yeah, it's a really good question. So within the plan, there's a mixture of active and passively managed funds. So what the committee and Aon tends to look at is, are there markets where investment managers could potentially have an edge? If we think about equity markets in general, what we tend to find is managers in the Canadian and international space tend to be able to have a better opportunity to add value over time, whereas markets like the US equity market are highly efficient. And it's the largest market in the world, the most number of active managers trying to outperform. And when you look at academic studies and from our experience working with plans across Canada and the globe, we tend to find active managers in the US struggle to add value before fees, and then you add on fees and they further subtract value. And so what the committee has done is focused their intention on using active managers in markets where there's potential to add value. So right now the plan does have actively managed funds within Canadian equities and within international equities, where it is daily managed by a professional investment management firm seeking to both add value but also provide better diversification and risk management. Within US equities and the Canadian fixed income fund, they're very efficient markets. It's tough to add value net of fees, and so the committee has utilized a passive investment strategy both in US equities and fixed income, so getting that broad market exposure in those markets.
Hello. I'm not sure for who my question is for, but I'm just going to ask it, so we'll see. As Sun Life is a private company, correct?
Publicly traded.
Yeah, but it's so it's not government covered or something like that. So what happens to the funds if something happens to the Sun Life?
Yeah, that's a great question. So Sun Life, and I will let Sun Life speak if I mischaracterize this, but so Sun Life is the custodian of the plan. So your assets are held in Sun Life in trust, but they're actually invested in publicly traded securities. So Sun Life isn't actually holding any of the assets on their books, and you're not exposed to the risk of Sun Life in any of the equity, fixed income, or money market funds. You're investing directly in publicly traded securities. That's similar across the industry. So the risk of Sun Life becoming insolvent, your investment assets aren't actually held with Sun Life. They're held with the underlying investments that are being made.
Yeah, I'm Sven. Thanks for your presentations. I've got a question with two parts, and I think one goes to John, one maybe to Garrett. John pointed out the options to delay or to accelerate the start date of payment in the case of the government funds. What is the counterpart situation on the investment side. So I assume if you retire, right, then of course the university doesn't pay you anymore, right, and you don't make any contributions anymore. But in many situations these days, you may not depend on the funds right now, right? And so unlike in the government system where there's a clear scenario, it might be valuable, let's say, to let the funds inside the investment portfolio without new contributions, but let it rest there 5 or 8 years or whatnot. Is that possible, for one? And if so, Garrett, what impact would that have on setting target dates for your retirement dates or takeout dates? So can you explain a little bit how, if any, options there are to juggle and try to take advantage of investments if you don't directly depend on the funds upon retirement?
So if I understand your question directly, I think this is the answer. So let's say you retire from here, but you don't want to withdraw the money because you don't want to pay income taxes on it, which you would if you withdraw. You can put in something called a locked-in retirement account, also called a LIRA, and you can put that in anywhere. You can put that in with Sun Life. You can put that in at your local financial institution. Pretty much everyone has LIRAs. You'll still be investing. You won't be putting any more contributions in. You won't be taking any money out. And by the end of the year you turn 71 at the latest, then you'll have to put it into that PRIF, the annuity, or a combination of both. Sure.
Stay in the plan and then go to the PRIF.
Oh, okay, right. So you can keep it in the plan and pay the low fees.
Yep.
And so,
So it can stay in the plan, so to say, also until the 71?
Yeah, until you put it into a decumulation product. So so you're forced out. Yeah, I got it. Yeah. So age 71, force out, that's a government rule, right? So that you can leave the money in, you can convert it whenever you want. So if you're going to wait, you're looking at it and you're able to wait until 70 to make that decision, then you can do it at that time. If you needed to do it at 60 or 65, then you could do it at that time. Locked in retirement account.
And maybe just to address the second part of the question. So if we think about from the investment perspective, the target date funds have been designed for, call it the average plan member. But we know, and especially as members approach retirement, that everyone's financial situation is different. And so what I would strongly encourage is Sun Life does have available, they talked about 360 plan advice and retirement planning tools. It's best to call them and have that conversation with your advisor or through the Sun Life advisors to help determine your full financial picture of assets within the plan, without of the plan, and from there you can make an informed decision of if the target date funds remain most optimal for you, or if you want to customize your risk profile using the other options. If you have a lot of money outside the plan, if you're taking OAS and CPP, you may wish to take a bit more risk in the plan. You may want to have more equities. Whereas on the flip side, if that's your only savings, you may wish to de-risk. So I think in that sense, and especially I'd encourage everyone as you approach retirement, that's when we start to see plan members looking to customize a bit more. If we think about plan members in their 30s, their financial situations tend to be a lot more similar. It's as you approach retirement where we see more divergence, where talking to a financial advisor and helping plan that out becomes more and more important.
Hi, I have a question from someone online, and I think this is for Alice. Does the statistics about the MPP plan include the funds that belong to pensioners and not just the active members of the plan? Thank you.
The stats are for members within the plan, not just active, so it could be deferred, but it does not include the PRIF, RIF, LIF. Do you think that answers it? Okay.
And I do want to clarify, just talking about the earlier question about what happens if a person leaves early. A person can leave their money in the plan. They get the benefit of the lower fees. The fees in the plan here are about 1/3%, versus if a person transfers their money out of the plan, now they're going to be charged I think the average out rate now is about 1.9% compared to about 1/3% in the plan. We don't recommend or discourage people from choosing either option. But we just want to make sure people know if they're choosing to transfer the money out, if they're leaving the university early or before they retire, that they do have the option to leave it and continue to benefit from those lower fees.
And most companies or most organizations do not provide that option, so that's very unique,
Yeah,
and a good
yeah,
option to have.
yeah, the point, yeah. This is a fairly unique feature of the plan here, is to allow people to stay in.
So, question for Garrett. Given the geopolitical happenings and the tariffs and everything, has Aon's outlook changed on the U.S. equities market? There's a lot of anti-U.S. sentiment out there. Just wondering if this will spiral into a bigger thing in this year and I guess the short to medium term.
Yeah, it's a good question. I mean, I think 2025 has been incredibly uncertain. I was making a comment. I walked into a meeting earlier this week, and there was 50% tariffs put on steel and aluminum. Walking out of the meeting, the tariffs were removed, right? And so I think the uncertainty, there's a lot right now. I think generally speaking, our view is being well diversified across regions makes sense. We haven't had a change in view around, should we not invest in U.S.? If you think about U.S. companies in general, they tend to be very global in nature, right? We're using them in Canada, we're using them in Europe and around the world. So I think for now, the view is to continue to be well diversified across regions. Makes sense from an investment perspective. Obviously, that may change as things continue to progress and remain highly uncertain.
Sorry, I had one more quick question for you, John. You mentioned that besides the lower operational costs and fees, another benefit of this such a, or maybe this in particular, deferred plan is deferred taxes, right? And so when you're in a high tax bracket, you save some taxes there. Once you get the money, you reinvest it in a lira or whatnot. This is untaxable. But at the time you take it out, let's say you've got $1 million. Do you, at this moment, have to pay a huge amount, right, based on the investments over the 40 years, or so the amount that is in this 360, that number given there, is that what you get cash on the hand, or do you then get a huge cut based on the gains that were made during the tax deferred periods or decades?
Yeah. It's completely dependent as to how much money you take out. So if you take out $30,000, it's just like $30,000 of income. If you take out $100,000, it's like $100,000 of income. So completely dependent. Just consider it as income.
It's not, okay.
It's totally income.
It's just an income.
Yeah, and keep in mind, when you do move it into that PRIF, you'll have to take out a certain minimum percentage, whether it's 3% or 4%. And yeah, it'll depend how much money that is.
But just by taking it out and moving over to PRIF or so, no tax in that second. Just when you, okay.
Like tax deferred.
It-
Because it doesn't get taxed until it's.
Right, it only gets taxed once you actually take the money out. So the government touches it when you touch it. So if, let's say you keep it in this plan, you're not paying any taxes on it. The moment you put in that PRIF and start taking money out, that's when it gets counted as income.
Yeah, and the reason for that, right, is the contributions that go into the plan aren't taxed today. So you're getting taxed when you take the money out, but you're not getting taxed today when the money goes in.
Yeah, so, but if you directly reinvest it in a lira, that's not considered as taking out.
Correct.
But if, let's say, you moved to a weird overseas home country and reinvested there, what happens then?
If you decide to take it to another country, my understanding is you'll be taxed on all the money that you move it into. Canada will make sure they get the money before you move it to a foreign country, and I don't know what the situation will be in that country.
I'm Murray Scarf. I'm an original member of the plan and retired in 2006. And so I just want to talk about some of my experiences with the plan. That a lot of people went to find contributions. They thought they're going to die by the time they're 80, and they didn't. And so they had used up the money in the plan. Then they sold their home, the capital gains on the home, so that was going to pay for their living. They're supporting them. Then at $4,000 a month, they found by the time they're my age or older that they had run out of money. And so that they had to watch what you do when you take the money out of the defined contribution, that you don't exceed it, and the value of your home is lost. And they can't pass the home then on to the kids because they've used the money to support themselves up to like I'm 86 now. The other thing when you're looking at investments, and I'm reflecting on my own, I put it into farmland. And I've had, since I retired, a 9% capital gains in the farmland and 6% return on the operating budget. So I'd be making essentially 15% per year. I don't have to pay the capital gains on the farm up to $1 million. And so I get exclusion. So when you're talking about investments, there are other investments you might want to make that have better tax benefits for you that will also yield income for you on your pension. And so I just wanted to point that out. The other thing, after 20 years of retirement, I retired with $1,100,000 in the Sun Life. I lost over $200,000 in the 2008 recession that happened. I'm still 20 years into the pension. I'm over 800,000 still in there, and I'm 86 years of age. And so you got to watch how much you take out, but the plan has sustained itself for me over the 20 years.
We didn't pay him to say that.
I think we're pretty close to time now, aren't we? Okay. Well, I want to thank you again for joining us today at this meeting. I think it was very useful information was provided to us. So thanks again, and have a great afternoon.